Mike. I am VP of Product here at Upstox, and I'd like to talk today about earnings season and how you trade around these earnings announcements. It's an opportune time right now. A lot of earnings kicking off right now. I think probably right now as we speak, Reliance is about to announce their earnings. Last week, TCS did, Axis Bank yesterday. So appropriate time for this. And one thing that really got me thinking about why I need to talk to traders about this is that I saw a question on Reddit that was posted yesterday, and this is a bit confounding maybe for some newer traders. They had thought that, okay, this one company thought it was going to have a poor announcement. Because of that, the stock price would go down. So they decided to lever up and basically have a leverage trading strategy by buying a put option on that move. Well, this is what happened for another stock. Uh, Same exact situation happened. Stock price went down 3%. Put option went down nearly 26% on the same move. So how do you explain that? That if the stock goes down, the put should go up in value because a put option is the right, but not the obligation to sell the price or sell the stock at a certain price on a certain date. Now, a lot of traders were commenting and saying that, oh, well, it was baked into the price or that it's theta decay. Well, yeah, that's kind of it. That's kind of it. But the big thing is it's about volatility. And that's what I want to talk to you about so you better understand that volatility is a different way of thinking. You should be thinking this way in terms of trading options, but it becomes more into play when you trade around earnings. So this is what happens with earnings, that what will typically happen is you have the stock price kind of trending a little bit, and then there'll be a big move up or down. Never really can be predictive, unfortunately. And this happens because there's a lot of information being released all at once. And if you think about it, that a lot of metrics that you think about for stocks, so price to earnings, price to book, price to EBITDA, the numerator is you have access to that all the time. That's the market price, the market cap, changing second by second. But what you don't have is a second by second view of earnings or EBITDA or book value. Those pieces of information only come out once per quarter. So the market is reacting to all of that. And there's going to be this jump process. And it's not perfect. It's not going to be like this gray line that you see right here where it just boop, perfectly goes up or perfectly goes down and markets are efficient. It doesn't work that way. There's going to be either an overreaction or an underreaction and a general trend. Not telling you how to trade like this. What I'm telling you is that this is an opportunity for you to put this in a watch list. And then from there, if it hits all your other criteria that you have in your typical day-to-day trading from a technical analysis perspective, should tip you off that that this is probably going to be a stronger momentum play because of this anomaly that's happening. All this information is getting released into the market and traders and investors are simulating it. And it's not just the data. You're going to have the CEO, the CFO, all the key management come out on an earnings conference call, talk about why it was so hard or so easy for them to hit the numbers this quarter, what's going to happen next quarter, how tariffs are impacting them, taxes, anything else in terms of the market, AI, what their next big plays are. They're going to be releasing all this information, and you're going to think about like, hey, is this going to continue or not continue? So it's this cool little combination of fundamental data and technical analysis data. And oh, by the way, this is something that happens every single quarter. This is another example right here from past quarter where you had TCS prior to earnings. You're seeing this little gray shaded area right here. And then this is on earnings day. And then post earnings, you had this downward drift. So on the earnings day, it was down 1.5%. But then after that, over the next 2 to 3 weeks, it kept trending downward. So let's take a look at where TCS is right now. So I'm going to go ahead and stop this right here, and I'm going to pull this up, and let's go to TCS, see where we're at right here. And we're seeing, don't conflate this and say that it's always going to go down. This is just what particularly happened in this example. So you saw it was fairly range bound right here. And then guess what? This was the earnings date, huge volume, downward movement on that particular day. These are hour candles. Yes, there was a bit of mean reversion right there over a 1 or 2 day period, but since then it's still been on this downward trajectory. So again, do your own analysis on this. But this is just an example right here of that these patterns exist over and over and over again. But we'll get to more of that here in a bit. So go back to slideshow mode. The reason, not really necessarily the reason why, but it's just something that is academic evidence that these phenomena persist is you go back to the US in the 60s, so decades back. There were academic researchers that identified this concept known as post-earnings announcement drift. So what it really said was that companies that exhibit large positive earnings surprises, they do really well in the future. And it's not necessarily that they're always going to have a positive return. It's just they're going to do well versus the average. They're going to do well versus the market. And you can't take this for granted that every single company is always going to do this. It's just on average. So if you take a look at this green line, these are companies that had really strong positive earnings surprises. And if you take a look at their drift, this is how much they beat the market by over a 240-day period. So this is a long-term phenomena, but it definitely does happen. A lot of it happens within the first few days after earnings. Similarly, on the other side, if you take a look at the blue line right there, this is where you have a negative drift, where companies that had a negative surprise, that's what happened to them, that there's this downward trajectory over time that it's just they're going to underperform the market. And if you were to do a trading strategy or an investing strategy where you're putting together a hedged portfolio, you buy the companies that had really strong performance surprises and you sell those that had really poor performance in terms of surprises. Put together this portfolio long, short, a hedge fund basically. And this is the historical returns you get for right there. You're doing pretty well. But again, this is an academic phenomena seen decades ago. Just what I was showing right here on the Upstox Pro Web. Similar screenshot right here. You just saw downward movement and you're seeing some downward trajectory right here. And now this is what goes back to answer the first question that I talked about, is that if the stock price went down, why did the option value go down? Well, part of it was it's baked in, but it's baked in from a volatility perspective, not a price perspective per se. That if you take a look at implied volatility, okay, it's trading at 18, 19%. And right before, the day before earnings announcement, hit 24%. Then from there, after the announcement was released after hours, the next day, market opens up, price is down. Well, guess what? People have exited all their options positions, or a good chunk of people have. That puts downward pressure on volatility, creating what is known as the volatility crush. So this happens, it's not, doesn't always happen, but it's a very, very, very common phenomena that boom, down 18%. So if you were a person that thought that, I'm going to buy a call expecting a good upward movement, or I'm going to buy a straddle expecting that I can trade the volatility, a big movement on there. Well, if you buy it too late, other people will have that same idea. It will have bid up the price. And guess what? They're going to exit their positions afterwards, and you're probably going to take a loss. So you have to be very careful around earnings because you have to be understanding volatility. And here's another way to really think about implied volatility. It's how the market thinks. This is a historical view. I really like this screenshot right here. It's of Twitter way back in the day, right before Elon Musk acquired it. So you can see that there's a big spike up, the pre-Q4 earnings, big spike up. And this was because there's a lot of uncertainty. And implied volatility goes up when the market is nervous because people don't know what to expect. So what do? They try to hedge. They go out there and they start buying calls and puts, or maybe they buy puts to hedge their positions they already own, or maybe that they have underlying stock position and they're selling calls to be able to kind of capture some of that volatility, which puts a damper on it. But really, it's about uncertainty. After the earnings are released, huge drop down in implied volatility. Musk is announced as the largest shareholder. Well, guess what? At that point in time, people were nervous. They don't know what he's going to do. And then from there, buying the rumor, sell the news, boom, it goes back down. So that's how you need to think about implied volatility. It's how the market thinks. If there's uncertainty, likely you're going to be paying more for implied volatility. So as I just explained right there, that's how that happened. It's about the volatility crush. So how do you trade this? There's a number of different ways you can think about this. You can trade it pre-earnings or you can trade post-earnings. Trading pre-earnings. So you can speculate on increasing volatility. We generally see this pattern of a couple days before and then definitely the day of or day prior, it spikes up quite a bit. So you could buy a straddle. The risk is that, well, there could be very little movement. There could be time decay. If the earnings announcement is right before expiry, you're going to be paying a lot in theta decay to hold this straddle over several days. Now, one thing you're going to want to do, because I'm a big proponent of not necessarily arbitrarily buying or executing strategies, but trying to do them in a data-informed way. So you can be smart about it. So you understand your risks. So pretty simple, just collect some of the historical data on the securities you're interested in trading. If they're liquid, if you have the capital for it, collect the data on those underlying stocks. See how implied volatility rises for those. That is your edge. And if you see that it's substantial enough to be able to be profitable, you're not going to be profitable every time, but if it's substantial enough, then that's a strategy you can consider. Another thing is if you have more capital and you are interested in holding the stock or you already own the stock, you can take advantage of this higher premium because as implied volatility rises, you can sell a call option on that stock. So if the stock happens to rise all the way up and hit that strike for that call option on expiry, unfortunately, you have to give delivery of the stock, so you lose out. So it's basically a limit order that you're getting paid for. You can think about it like that. And the biggest risk is you're owning the stock, same level of risk, because if it goes down in price, well, you're already going to be exposed to it going down anyway. Um, Another thing you can do on the post side is you can speculate on decreasing volatility. And we kind of saw that already. So right before earnings are announced. So for example, Reliance is announcing right now, implied volatility will be the highest right before the earnings announcement. So a couple hours ago before the market closed, would have sold a straddle. And then from there on Monday, if implied volatility goes down enough and Reliance stays within a narrow band, you could be profitable on there. Of course, the risk is that, well, what if the underlying moves significantly? That's the biggest risk of doing this. So what you want to do to keep your edge is understand how much implied volatility typically moves whenever that earnings is announced, what typically happens, just so you have some idea of, hey, I'm going to win 8 times out of 10, 7 times out of 10. And when I lose, what does that typically look like and how can I best hedge to be able to exit out of my position cleanly? Lastly, there's this idea of, we talked about the speculating on the stock drift. So this isn't speculating on the movement. That's super risky, very, very risky to speculate on whether or not it will move upward or downward on the earnings day. Hard to do. However, once that move happens, the earnings comes out, you can then take a look at your technical analysis, all the data that you have, typical trading things you're usually using your portfolio. Use that to then speculate on whether or not you believe it's going to keep drifting one way or the other, or do a mean reversion because sometimes they overcorrect or they overcompensate and there's a correction, as we saw on TCS, that one chart where a downward move, correction, and then it went back down to a continual drift over the last week or so. But again, collect data, understand your risk reward benefits associated with this. And quick tactical example before I get into some potential, taking a look at Reliance and taking a look at Infosys, which is announcing next week, just to kind of give you some ideas of the opportunities. So caveat, these are back-tested results for educational purposes. conduct your own due diligence on any of these things. So this is the Indian Oil Corporation. They announced, this is from an announcement a couple quarters back. Earnings announcement after the close, 143.45. Waited until after the impact sorted itself out, and you entered in the position. 2 days later, again, assessed what was going on, took a look at the technical analysis trends, and figured that, hey, green candle within the particular day, let's follow this trend up. And let's just say you decided to hold it for 20 trading days, approximately 1 month. What would have happened? Again, illustrative example, but still real data. You would have exited the position right there at 166. So total return of 13%. So for an investor, pretty solid return in 1 month. Peak return of around 31%. And this is something to also kind of keep in mind is that because all this information is coming out around this time, this does provide the best opportunities for capturing a lot of returns. There's some other historical data. I don't want to go off topic, but if you look at open to close returns of the market and close to open returns, typically close to open returns are higher than open to close returns. So what that means is that the overnight effect, holding a position overnight because you're accepting more risk, has a higher return on average than if you're just to trade a position during the day because there's no liquidity. And same thing over the weekend as well. There's like weekend effects, day of month effects. But again, that's for another discussion. But it's very, very similar concept that all this information is happening right now, so you can really get compensated by the market for taking the risk at this point in time of the year. Now, if you're doing this exact same trade with options, if you're to take a call option on this, this is just the impact of leverage, where instead of it being plus 12%, you're looking at a 200% gain. And instead of a 30+% gain, you're looking at a 600% peak gain. Of course, the risk is that, well, if this trade didn't work out, you lose up to 100% of your capital, versus you would still own the stock if you decided to trade the long stock. So bit of a difference right there. So Reliance, this is where it's been in terms of implied volatility over the last week or so, maybe 2 weeks. So you're looking at 16, 15%, and over the last couple of days, it's spiked up to 19%. So let's go over to the charts right here and click over to Reliance and options chain. So where is it at? So the at the money strike right here, 1476, right in between the two, but it's closer to this one. So I'd say the at the money is the 1480. If I take a look at this implied volatility, 22.3%. So it's doing the exact same thing it typically does over and over again. It rises right before the earnings announcement. And just as a bit of a refresher, implied volatility, what that really is it's the market's way of showing you the standard deviation of the underlying. So what the market is saying, that it believes that Reliance right now will move plus or minus 22% over the course of a year. It's an annualized standard deviation value. And standard deviation is 65-ish% of observations will fall within that range. So little statistics, but that's really what it's implying, that the stock's going to be more volatile. That's what you're paying for. Now, when you look at this right here, if you were to buy a straddle right here, that would have cost you had to buy the call, that's 25.25. You would have to buy the put, that's 23.70. So roughly 49 bucks is what you're going to be paying for this. What that equates to is the implied move is roughly 3%. Now, what do I mean by implied move? That's what the market is implying in terms of move. Because let's just say you believe, and everybody in the market believes, that a stock will move plus or minus 100 within the next week. Now, if you were to buy a straddle and maybe that straddle only cost you 50, well, yeah, you're going to buy that because you're going to profit 50, potentially. People will keep buying it. That's going to raise the price from 50 to 60 to 70 to 80. And what's going to end up happening is that at some point there's going to be a market equilibrium that supply and demand is going to meet right there, and it's not going to change in terms of price significantly. So that's the market price. It's that you're implying plus or minus 100. And what we're saying right now is that the market is implying that it's going to move plus or minus 3% between now and expiration. So a couple other things we want to take a look at on here. So theta. This is something, if we were to, again, hypothetically, if we had entered into this trade, like maybe we had bought a straddle right before market close, expecting a huge move, what would the headwinds be? Okay, one, it's theta, because we're going to have to hold this over a couple of nights. And that right there, that theta 0.9547, for every day that we hold this, the value is going to go down. So we hold this one day and nothing else changes. 25.25 will become roughly 24 and change, 24.25, something like that. That's that's a pain punishment you're gonna have to take to be able to enter into this position, but everybody hopefully should be fairly aware of that. The other thing is Vega. Now, as I was showing you, that implied volatility has gone up from around 15 to 16 to now 22. Well, what if it goes right back down to 15 or 16 on Monday? What does that mean? Well, if nothing else changes, just assume that your price stays the exact same. We're ignoring time, just goes back down. So that's 7 points, 6, 7 points that it's going to go down. You multiply 6 or 7 points times that Vega value right there. So you're going to lose 6.6 to 7.7, depending upon how far implied volatility drops from that number from 25.25. So you're already facing a huge headwind in terms of how much the underlying needs to move. So you get that back from delta, from that Greek. So that's the biggest challenge with trading long straddles ahead of earnings. And typically where most people, they would be shorting straddles going into this because it's probably an easier bet to make because you have huge headwinds. And if you're going to do this, well, you're not just going to lose or have that risk of Vega decay or Vega crush on the call side. You also have that on the put side. And as a reminder, Vega equal on both sides right there. So going back to this right here, go back to the slideshow. You see Reliance, we already just talked about that. And this is the implied move that we've been seeing. An implied move typically goes, if nothing else changes, it's going to go down because of time decay. But if we were to take, as we took a look at it right now, the implied move is a bit higher because of this. The caveat is that this implied volatility crush doesn't always happen. So there's no free lunches on Wall Street, as they say. That if you take a look at the chart on the left, that you have Reliance that has gone down, and then from there you have Reliance that has stayed flat in terms of implied volatility crush. So you never really know, but typically the implied volatility crush happens 8 times out of 10. I'm gonna not a perfect number, but the implied volatility crush is far more likely to occur than no crush. But again, just something to keep in mind from a risk reward perspective. Now, what happens and what has historically happened over the last 2 years of just looking at Reliance in terms of historical momentum returns? As I talked about, there's a couple different ways to trade earnings. You trade earnings ahead, talking about long or short straddles, and talking about the implied volatility. And now you can also look at, well, what happens after the announcement? So this is the impact day +1. So impact day for Reliance will be Monday. So today, not a lot happened other than people buying options, and which raised the implied volatility. But if you look at the price, no change. Change in price will happen on Monday because all this stuff is happening after market hours. So it's going to happen on Monday. So let's just say at the end of trading, at the close, you enter into one of these positions, a long stock, a long call, a long put, or a long straddle. What would happen if you held that for 1 day, 3 days, or 5 days? So if you buy it on Monday and held until Tuesday, or buy it on Monday, held until Thursday, etc. That's the logic behind this. As you can see, there's nothing consistent. So Again, no free lunch on Wall Street. No perfect trade out there. There's always risk reward, so you need to perform your own due diligence. But I highlighted in red right here that this is kind of an interesting thing. At least over the last 2 years with Reliance, it seems that going a long straddle seems to underperform over the couple day horizon. Perhaps this is because uh, people it's a little bit richer in terms of implied volatility. Maybe it takes longer for implied volatility to go down. Maybe yeah, it's just not a big mover afterwards. So that right there, just wanted to share this, that generally speaking, the short straddle over the last 2 years has been the slightly better momentum trade. Then you can, of course, all these others, that is what they were, but it's very tactical. You want to take a look at your charts, technical analysis, all your other tools you have in your kit to be able to determine what you want to be able to trade for these, whether it's long call, long put, long stock, short stock. Let's talk Infosys. Let's go to the chart real quick on here. Let's see where it's at right now. Infosys, bit volatile today, and let's see where the options chain is at. So it's at 1586. So 1580 is the at the money. Implied volatility is 3320. So now let's go back to here and see where it's going up, continue to go up. And this stock right here is announcing earnings after market hours, I believe on the 23rd, on Wednesday or Thursday of next week. So this is already starting to have some interesting ramp going into this. So far sooner than some of these other stocks we've looked at. And this is historical straddle returns if you were to enter into this ahead of time. So the impact day, so if it's aftermarket hours on the 23rd, which I think is Wednesday, then it'd be on the 24th is the impact day, Thursday. Then you're looking at maybe Monday. If you were to enter at the start of the day on or at the close on Monday, this is the kind of the theoretical trade for all the last 2 years of this right here. So you can see that again, nothing super consistent, but what we're looking at is a long straddle consistent with you're seeing a rise in implied volatility. Maybe this performed better if we took a look at further day, more days out in advance, because as we saw on this right here, that definitely there's an implied volatility ramp many days in advance. So again, conduct your own due diligence, but this is another opportunity that you have right here coming up with Infosys. And to kind of wrap this up, that couple of different ways to trade earnings beforehand, speculate on the increasing volatility so you can buy a straddle leaning into it, hoping that um, it moves either significantly or implied volatility rises enough so you can earn and collect the premium on that. You can do a covered call if you have more capital and you own the stock. Post earnings, you can speculate on that volatility crush. So technically, for this third trade right here, you're entering in right before the earnings announcement, selling a straddle. And even though I say sell a straddle, you can also enter in a butterfly, which is a hedge straddle, or you can do a strangle, sell a strangle. So that's selling a call and a put with differing strikes, or you can do an iron condor, where it's basically a hedge strangle, where you're buying, or sorry, you're selling those two strikes and you're buying further out strikes to be able to hedge that. So that's the one risk or huge risk associated with selling straddles and strangles, is that there's potential for near infinite downside. And then, of course, lastly, taking a look at the momentum play associated with anything post earnings with all that new information coming out, whether it's a momentum play or a mean reversion play. But again, look at your technical indicators to be able to assess what the best opportunity is for this. Always look to gain an edge in anything you're doing in terms of trading, whether it's collecting historical data, doing back test, testing out small, and then slowly scaling up. Not here to provide any type of advice, just trying to guide you in terms of potential opportunities. And with earnings season, a lot of opportunities that are out there. And with that said, thanks, appreciate your time, and best of luck.